Good afternoon and namaste. I'm Rajiv and your host for today for this event. It gives me immense honor and privilege to host this event today related to taxation on behalf of our organization NCAIA. NCAIA or National Council of Asian Indian Association is an umbrella organization for all Indian communities, an organization to mutually support and strengthen our fellow brothers and the sisters in the US. The talk would last almost for 40 minutes and it will follow by a question and answer session. Audience are encouraged to share their queries through chat, which will be further collated and presented to the speaker by our coordinator Shashiji once the talk is over. So without taking much time, I'll set the event off by introducing our president, Ms. Nana Desai. Ms. Desai is newly elected president of NCIA. She lives in the greater DC area and she has been volunteering, serving, and she also has headed multiple Indian communities for last 12 years. She has also served as president for Gujarati Samaj in the DC. So Nana ji, over to you.
Thank you, Rajiv ji. Good afternoon, everyone. I'm Naina Desai, President of NCIA Washington Chapter DC. On behalf of NCIA, I express my greetings to you all. We also have our National President, Mr. Harish Kolasani, live from Chicago. We have our CPA, Mr. Manjit Singh, with us today to share his knowledge and expertise related new tax laws to our community. I very much appreciated time given to us. Despite his busy tax season, excellent work has been done by our coordinators, Sashiji, Ashaji, Rajiv, Krapaji, Mukundagasiji, and many more behind the scene. Please enjoy the session. Thank you. Thank you.
Thank you, Nana ji. Now I'll take this opportunity to introduce our event co-coordinator, Mrs. Asa Chand, and request her to introduce our keynote speaker for the day, Mr. Manjit Singh, who's CPA. Mrs. Chand is NCAIA Vice President for Community Affairs, and she is also associated with many local Indian associations, organizations, senior groups, and temples. In DC, Asaji is well known for her passion, drive, and adroitness at Hindi language. She has also served as president of DC, Virginia, and Maryland chapters of International Hindi Association, IHA, in the recent past. Asaji, over to you.
Namaskar. Thank you, Rajiv. My name is Asha Chand, as Rajiv introduced me, and it is my great honor and pleasure to introduce you our keynote speaker, Mr. Manjit Singh. Due to time constraint, I will share a very brief summary. Mr. Singh completed his MBA from GW and passed his CPA certification in 1987. His firm has been providing accounting, payroll, and income tax services in Virginia, DC area for a very long time now. In tax and financial services, ethics, integrity, and accuracy are of utmost importance and are the qualities of Mr. Singh is well known. Mr. Singh is known as a trusted advisor, not for only having expertise in other things, but he have expertise in offshore voluntary disclosure programs. Many of us have seen him time to time on various local TV channels. Friends, now we all are very eager to listen to Mr. Singh on a topic that NCI has selected that greatly concerns us and our future generation. Please join me in a big round of applause to welcome Mr. Manjit Singh, key speaker of today's program. Thank you.
Can you guys hear me?
looks like he's not on mute. Please unmute him, and Manjit ji, unmute yourself, please.
I did. Let's see. Can you guys hear me?
Yes, we
Yes.
can.
Namaskar to everybody, and thank you very much for inviting me to talk about the tax law changes in 2020 returns. We have received some questions already in advance, and there are some items that we are not sure what it really meant. So as we go through the presentation, I will try to answer those questions that we have already received from the organizers, Sashiji and Ashaji. So for the year 2020, which means the prior year, January 1 to December 31st, 2020, the tax returns are started being accepted by the Internal Revenue Service on February 12th, 2021. That in itself is 3 weeks late. In the past, whenever we have filed a return, we were able to file the return after January 15, 20 of the year. Unfortunately, the logic for being late was due to the changes that President Trump signed on December 27th with respect to additional funds for the economic recovery credit, and there were some other minor adjustments made in that program, in that tax bill. It's a 5,000 bill, a 5,000 pages bill. I honestly did not read the whole thing. I just read the summaries from other people. So for the year 2020, as you all know, President Trump in the beginning of 1918, with the first tax return done in 2019, the standard deduction amounts were raised and the personal exemptions were taken away. In the current year, the standard deduction is going to be $20,800, if I remember that correctly. And where did my worksheet go? That's a little embarrassing, but you guys enjoy it at my cost. For an individual married filing joint, the standard deduction is going to be $24,800. So in other words, when you were itemizing in the past, claiming itemized mortgage interest, real estate taxes, car tax for people living in Virginia. Hey, what happened? Can you guys hear me?
Yes.
All right, because, there's the presentation. All right. How do we move the screens here?
We can hear you, Manjit bhai. That's fine. Go
All right,
ahead.
Just let me know. I'll move the screens for you.
Continuing on that standard deduction. So if those items are not adding up to the standard deduction, you are automatically reverted to the standard deduction of $24,800 for married filing joint returns. For single, it's exact half, $12,400. There is a special category for people who are head of households. For them, the standard deduction became $18,650. In the past, if you recall, we were all allowed to claim state income taxes that we ended up paying in the previous year, along with the income tax return, state taxes withheld from the W-2s or any other sources. For example, somebody who got retirement funds from the government and the tax withheld was there. Real estate taxes, car tax for people living in Virginia. Unfortunately, Trump's law restricted that to 10,000. So if some people who are closer to the payoff of their mortgage the interest is not that high, and you're not reaching that standard deduction level, you're gonna automatically claim the standard deduction for better tax advantage. As you will see on the screen, there are some other advantages for people who are over the age of 65 and for people who are unfortunately blind. They get extra amounts added to their standard deductions. The most important part of the Trump tax laws that was signed after the pandemic started in March was $1,200 for each individual who had filed a 2018 tax return. It was based on that, and there was income levels. So a married filing joint individual got up to $2,400 in credit, free money to spend irrespective, and it's not supposed to be included in as income. If they have dependents under the age of under the age of 17, they are eligible to get $500 additional. As I mentioned, in December 27th, additional amount of $600 was authorized, enacted, and distributed in early part of January 2015. January of 2021 up to January 15. Thereafter, they stopped it. Now, we have had a lot of people come and complain, hey, I filed my return late. I have not filed my 2018 return. Or some people who were on Social Security benefits where their income was not subject to income taxes, they had not filed their income tax returns. How would I get my stimulus money? A provision has been made in the current year tax return, and that is, you identify it. I did not receive the $1,200 individual credit I was supposed to get, or I did not get the $600. Either of the two didn't get, or I got both, or I didn't get either. So the tax return will compute it and provide you with that amount that was missed. Please do remember, for people who are making or have adjusted gross income of 150 and people who are head of household of 112,500 and 675,000, the phase outs starts and you don't get it. That's the sad part. The second topic that we would like to talk about and is the capital gains tax rate. Currently, if you have Social Security income, you buy and sell stocks, you sold real estate, and you don't have any additional income except capital gains. If the income is below a certain number,
We cannot hear you, Manjit bhai.
I think we lost him.
We lost
Manjit,
him.
are you still with us?
He's frozen now.
Yeah, he's frozen. Probably he has to re-log in or something, maybe.
उनके स्क्रीन पर है.
शशि जी, मंजीत जी को कॉल करिए, दोबारा लॉग इन करें।
और कहना को बाहर नहीं जाए, बाहर सर्दी काफी हो, फ्रीज हो जाते हैं।
अंदर रहो घर के।
Sriji, your second audio should be muted whenever you are speaking. Echo आ रहा है.
Yes. Let me.
Or you can use headphone for the second audio.
Hello, folks. Can you hear me?
Yeah, we can hear now.
Please forgive me about these computer glitches. Don't understand why this is happening. So if you don't have any additional income from any other sources, the good news is on the capital gains, the tax is zero. For the 2020 applies for individuals whose income is up to 40,000, 53,600 for people who are head of household, and $80,000 for married filing joint. From that point onwards, you have additional income from other sources like W-2 wages or passive income from investments, interest incomes, all other incomes, rental incomes. The capital gains tax rate on that is 20% for married filing joint up to $496,000. Remember, at this point, you have two different tax levels going on. One is your regular income tax, and the other one is the capital gains rate. If your income, let's say, is $70,000 from other sources, you are still in the lower tax bracket. It's not that you're going to add the two together, $496,000 of the capital gains and that. No, up to $496,000 of capital gains is taxed at 20%. The $70,000 from other activities is going to be taxed at the tax bracket rate. Please do remember one more thing here. There is one thing that our former president had done was this 3.8 surtax on net investment income and NIIT. That makes it the capital gains tax rate slightly higher. Not to confuse you, we have heard that the new administration may increase the capital gains tax rate to 28%. Let's keep our fingers crossed that it does not happen. That's stupid, ridiculous, because if you add the state level, it's making it go upwards to 32, 33%. Now, the next subject that we can discuss is the charitable contribution. On the itemized deduction, we are allowed to claim the charity that we gave to the temples and to all other nonprofit organizations. Please bear in mind, the charity donations are eligible only to US/Internal Revenue Service recognized organizations. You donate it to your temple back home in the village. If it's not recognized by the Internal Revenue Service, who have the EIN number, that donation is not a deduction. What we have seen is alumni from the schools, from religious organizations. They have created local chapters in the United States, gotten the federal ID number and exempt our certification. So if you provide the donation here, like the Aurobindo Ashram, then you are eligible to claim it on your individual tax return itemized. But remember, I indicated to you that if you are not able to itemize due to the real estate taxes and those things gone away and it's falling below the standard, the new provision is cash payments of up to $300 is eligible to be claimed on your individual income tax return form 1040, page 1. It is per return, not that you're married filing joint doing 600. No, only 300. All right, the next part is the 401ks, retirements. To be very honest with you, with all the deductions and everything else gone, the best benefit of tax savings is the retirement accounts that was left. So when you're working some places, you have the opportunity to contribute out of your own salary, which some people call it employee contribution, salary deferral, whatever terminology you may want to use it. 19,500 was the amount that you could contribute out of your own earnings. If you are age 50 and above, which means born before 1971, we call it the geezer catch-up in the accounting and accountants terminal group. That's 6,500. It's because people who did not start contributing at the early ages of their life, they are given an extra opportunity to put in 6,500. So the total was 26,000. You will see this deduction on your W-2s. It is marked, coded on box 12D code, deferred contribution. There's other plans also for some employers who did not decide to go with the 401k. It's called Simple IRA. That dollar amount is 13,500. And for those individuals, the catch-up is an additional only $3,000. The traditional, if you don't have anything, you're not participating, or your W-2 is not marked retirement account on your W-2, which means now privately, you can go and have an individual retirement account and put in $6,000 before April 15th. Please remember, in 2019, taxes that became due on July 15th, because the date was pushed from April 15th to July 15th, the eligibility to put money into an individual retirement account was July 15th. Don't want to make people upset. It seems like there are some congressmen or lawmakers that they are saying, let's extend the deadline again this year to July 15th. Will it happen? Will it not happen? Don't know. But if you guys are using this vehicle to save money, please remember April 15th so far with no extensions as yet. Keep your ears and eyes open. The Roth IRA contribution is the same, 6,000 plus 1. The difference between the two is in a traditional IRA, you're putting the money, you're reducing your taxable income. In a Roth IRA, you're contributing it, but you're not reducing your taxable income. The second side of that, or the second part of it, because you're putting money into an individual retirement account and you're taking the benefit today, when you start withdrawing the funds out of the individual retirement account, the traditional, whatever amount you take out is going to be subject to income tax. Now, there are two thoughts. Before I talked about the thought, let's tell you about the Roth IRA. So because you put the money in Roth IRA and you did not get a tax write-off today, so when you take it out, you do not have to include it in income. The Roth IRA is traditionally excellent vehicle for the people who think that when they retire, whether at the age of 62, 66, 67, 80, 70, all right? Their income tax bracket is going to be high, therefore, they would contribute into Roth IRA. I will share you with my personal experience. I would put money into the traditional IRA because I like the bird in my hands better than two in the bush. I don't know whether I will withdraw all my funds from my 401k or my Roth IRA, or my traditional IRA. I'd rather save the money before giving it to the government to spend it and waste it and places which I don't agree with the government where they should be spent. And second thing, if I have a huge balance and there is money sitting there and I die, let my beneficiary pay the damn tax because they got free money. Hey, I thought you guys would laugh at that, but that's okay. So some people who are pretty affluent, they may not be able to get the traditional IRA deduction because of the additional ceilings, and there are ceilings for the Roth IRA. If you are making between 196,000 to 206 for couples, you are not allowed to put money into the Roth IRA. So what we have seen is something called backdoor money into the Roth. They put the money into the account, traditional IRA, but because the amount is more than what they're allowed to put in, and or they are not allowed to put in because they already have put in money into a 401k, they move the money after a few months into a Roth IRA. The benefit is the earnings in the Roth IRA is non-taxable. And when they withdraw it, that part of the funds will not be subject to income taxes as well. There was a question sent earlier to the organizers, Sashi and Ms. Chan, if not mistaken. It said, can I have a joint IRA? Unfortunately, no. The IRAs are specifically based on an individual's Social Security numbers. They are not joint. If one passes away, the survivor gets it as an inherited IRA. All right. Are you guys all confused? Okay, so far? Great. Now let's get into this next subject and the impact of the Secure Act, which was also passed in the month of March. And that said, because of the pandemic, people who had the retirement accounts were forced to take the required minimum distribution after they attained the age of 70 and a half. What the law passed said that let's put it an extension by 2 years. So instead, if you are going to become eligible to start taking RMDs in this current year or in the past year, you got a reprieve. And the banks, financial institutions such as Merrill Lynch, Charles Schwab's, Vanguard, Fidelity, they were very good in educating and advising their client base. Hey, wait a minute, you don't necessarily have to take it out. The restriction has been pushed for an additional 2 years. And if somebody had taken it out before December 31st, the financial institutions were also sending out emails and in their newsletters, hey guys, if you want to, you can put it back. The other impact of the Secure Act was way back 10 years ago, 5 years ago, if you were going to spend money in adopting children from overseas or anywhere, even in the country, they were giving you guys $10,000 write-off. Unfortunately, now we are allowed up to $5,000 without having to pay any penalties. You can take the money out of the 401k plan. At this point, I think it might be advantageous to talk about that we have now $12,400 as standard deduction. So if somebody is self-employed or has their own business and want to use their children in business and pay them a salary, wages up to $12,400 for the year 2020 is not subject to income tax. And if you are able to put in additional funds into the traditional IRA, you can take the limit of that W-2 to $18,000. Well and good. Hey, Manjit, you just told me if I put into Roth IRA, I don't have to pay taxes when I take the money out. But let me put it this way. There is an exemption of the 10% early withdrawal of funds. Either you take it out of your 401k plan, IRA accounts. If those funds are being used for the education of your child, education of yourself, you will include only the amount withdrawn towards income tax. No 10% early withdrawal. I have suggested that strategy to some of my clients. They are very good, happy with it. There are some people who are not happy with it. And believe it or not, please don't mind. One guy even fired me because I told him 3 times. All right, that's his choice. The amount, the funds that you can put into an IRA account has to be something that we call it as earned income. In other words, monies on which we have paid Social Security and Medicare taxes. There's an exception. Fellowships, stipends paid to the graduates, doctoral students are treated as earned income, especially for the IRA contributions. You are not required to pay Social Security and Medicare taxes on it, but you do pay income taxes. I know quite a few of you guys are here and have worked at the NIH, where you have seen either your children have worked at the NIH and they get scholarships, studentships. Those, and they do issue a 1099. Those are subject to income taxes, not Social Security and Medicare taxes. Now, there was a question earlier that was sent to us about the inherited IRAs. And therefore, we put a slight little item here. Inherited IRA does, I thought maybe able to go into an estate and let the estate pay the tax, but no, that doesn't work that way. It needs to, when you have a life insurance policy, when you go to open an IRA account, when you open a 401k account with any of the investment houses or your employer, you are going to dictate who is going to be the beneficiary, your spouse, your children, what ratio the children, what ratio the wife, if you have more than one, I mean, not at the same time, okay? So the investment houses, which is holding your funds, is going to hold it. If I'm not mistaken, the funds needs to be transferred from your account to an individual's inherited IRA account. And from that point on, those people have, I believe, up to 5 years to withdraw the money. If an individual was already doing the RMDs, the inheriting person will have to continue the continuation of the RMDs. Another thing that really happened, which was very, very interesting, And it happened only once so far in the number of years that US government is collecting income taxes. Anytime you withdraw funds from your retirement account, 401k or individual retirement accounts, the whole amount is subject to income taxes. What they did is give an exception of either you pay the whole taxes on the whole amount. I delivered one tax return yesterday. The individual took out $99,000 plus small amounts, which added to around $3,000. So in their situation, if they were willing to pay the tax on the full withdrawal, they had the resources. However, there was also a rental property loss. And we looked at it and we saw that the rental loss being greater, the income becoming greater than $150,000, the rental loss was non-deductible. The income tax bracket of the individual went up to 24% for federal, let alone state. In Virginia is 5.75%. However, the new provision is you can split it over 3 years. Include 1/3 this year, includes 1/3 next year, include 1/3 the year thereafter. So out of the $100,000, $33,000 paid plus 3, it dropped their income tax bracket down to 22%. Plus, the income became $123,000, not greater than $150,000, where the $7,000 suspended loss would have gone. So they come out ahead. Please, I have geared this presentation especially for those who are interested in trying to do their own returns and not rely on a professional. These are the highlights for them, okay? Now, if there was a dire emergency, hardship, the law also, your 401k also provided withdrawal from your funds, 50% of the balance of the 401k, or $50,000, whichever was lower. On September 23rd, based on the CARES Act, they allowed you to withdraw the whole 100% and no 10% early withdrawal penalty. That is a great thing, but as I gave you the example, you want to be sure what you can take the money out, put it in an investment somewhere else, but be careful, where does it push your income tax bracket? Now, for those who are, we have many a times people from the international community, those who work at the World Bank, UNICEF, WHO, IMF, IFC. So for those people, we have another slide in there, and you need to strategize when you want to take your retirement. Might be boring for other people, but bear with me. I won't try to put too much time in there. You have the ability to take the funds out and get something called the commuted part and arrange your affairs so that the amount is non-taxable. 22 years ago, I had a gentleman who came and told me, hey, Manjit, I'm using you for tax filing service, and not the other guy is a CPA, is an attorney, okay? No matter what, we have gone through the same grind. We know what we are doing. You can't take the money, strategize to take the money in Singapore. At that time, they had to go out of the country to get the money. These days, you can get your money from the international organization while you're still in the US. The gentleman tried to get the money when he was in a country where the income tax rate was only 3%. Hey, that's great. If you can do it, I'm all for it. All right. Now, for those very same individuals, please be careful when you switch or take on the green card. The interesting part here is, ever since that offshore voluntary disclosure process came into picture and the Internal Revenue started going after people who had funds, incomes overseas and not reporting in on their income tax returns, you becoming a green card holder have to report on your worldwide income. If you have income coming out of Bangladesh, if you have income coming out of India, Pakistan, please forgive me for using those names, even though this is an Indian organization. We deal with all kinds of people, and we do not discriminate. So always remember, those incomes are supposed to be added to your income tax return. Holy cows, I'm going to get double taxed. No. Very many countries, the 3 countries that I mentioned, they do have a tax treaty with the US that there shall be no double taxation. All right. If you have paid taxes in India, you will claim, you're going to show the same income here on your individual income tax return in the US, but claim the refund that I paid taxes in India and I want the credit. It's called Form 116. So for people who are from the World Bank community, international community, also remember, as a matter of fact, doesn't matter to just them, everybody. You have resources overseas, you have income overseas, you're supposed to file something crazy called the F-bar. There are 2 kinds of F-bar. One is foreign bank account. That's Form 114, FinCEN. Earlier, it used to be called 98.TD1 thing, but thank God they got rid of that. And they became a simple number 114. You have to go to the BSA, Bank Secrecy Act website to fill it up. First, you have to create an account, then go back in there and fill in the information. It doesn't cost you anything. It doesn't cost you any income taxes. It's just an informational form for the Internal Revenue Service. This form goes to one division of this Treasury. Guess what? Another part of the Treasury doesn't talk to each other. This is strictly confidential information. If the F-bar form is not filed, whether you have signature authority over $10,000 or not, if so, you need to fill it. If not, you move on. What if I have more than $100,000? You're supposed to do the similar form as part of your individual income tax return, 8938. 90% of the information is exactly the same. Name of the bank, branch address of the bank, how much money is in there, in which currency is it in there, how much is it converted to US dollar, what rate did you use for the US rate conversion. There is a special website that's the rate we are supposed to use. That goes as part of the individual income tax return. So that's the other part of the IRS gets it. It's for the compliance purposes. There's the F-bar, and then there's a FATCA. A very many number of people thought, hey, I don't have to do it. That form is the second part, F-bar, is asset reporting. The first bar, the F-bar, A stands for account reporting, right? Only cash equivalent, or something that can be converted into the cash very easily. If you're holding debit cards, money on it, it's cash equivalent. Remember in the old days, we used to have these prepaid telephone cards. They're cash equivalents. All right. The next part of this, if you don't file the F-bar, the penalties can be as high, the F-bar with the 114. The penalties are severe. I had posted an article in LinkedIn as well in Facebook in about 2 months ago, where the IRS went into the estate of a deceased person. Hey, you didn't file the F-bar. You started filing it, you dropped it, you're dead. We found out you have money. They tried and got it, right? The next part is if you receive gift from overseas, if you receive inheritance overseas in terms of cash, you decide to bring it into the United States. There is a special form to be done, 3520. It's a 4-page form. The last part tells you, talks about the gifts. If you don't file it in a timely manner, and it is due with the income tax return. So if you are on April 15 deadline, it's due April 15. If you have an extension, it's due on October 15. You don't file it, the IRS finds out, straight flat 10% penalty, civil penalties, not income tax penalty, it's civil penalty. Manjit Singh CPA PC is trying to fight one individual because the gentleman filed it a week later. The tax return went out, but the 3520 was filed late. The IRS knew it because the money came in from overseas. You need to file the 3520 if you receive or you bring in 100,000 plus. Our philosophy here in this office is, when in doubt, file it. Doesn't hurt. Just about a week ago, another CPA who is very good friend, we exchanged notes, we exchanged information with each other. And he was asking, Manjit, I just became friends with this gentleman. Sorry, not friend with this gentleman, but this guy came to me as a client, and now he's gotten an interest in a LLC in India. In India, LLC partnerships pay taxes at the partnership level. In the US, we pay taxes at the shareholder partners level. What form am I supposed to file? For the corporations, if you own shares in a company in India, whether public or private, you file 5471 as part of your individual income tax return. If you are a member of a partnership, you file 8865. There's another thing also, which our buddy Trump started, and that was called GILTI. It has to do with something about the global income tax. Not a very easy form. Please don't try to tackle it yourself. Very complicated. Even I myself have made a mistake. I had to go back and revise that form. Luckily, it was not filed. And by the way, I am very grateful to God who has given me common sense to be able to learn all these things and share it with all you people, irrespective. And I was not born knowing everything. I learned it with what they call ठोकर खा खा के, हाथ जला के. Anyway, ladies and gentlemen, I was seeing at the bottom of the screen, there were questions coming in. And so let me know if there's some elements that we need to address. I did try to pick up the old questions that was presented. And one thing that I just remember is one of the questions that was given to me earlier was, is agricultural income taxable? Let me ask you a question. What do you mean by the word agriculture? In the US, we call it farming, right? Who is the farmer? The farmer is the person who is actually going and working in the fields, and therefore he is getting income by sale of his crops. In India, especially, I've heard people from the Punjab community or state, they are not farmers. I'm sorry. They are landlords. The landlords have leased out their land. They haven't sold it. They have leased out their land. So what are they collecting? Farming income or rental? That is the question. Is the farming income or agricultural income taxable? India says no. US says yes. So you have to put it down on the US income tax return. Especially if you are actually tilling the land. But if you're collecting the rent and still living in Canada or US or Japan or anywhere, it's not farming income. It's, my point of view, it's rental income unless you can convince me otherwise. All right, guys? Ready for questions?
Thanks a lot, Mr. Singh, for such a stunning and thorough presentation, providing a deep dive of all recent tax-related regulations. This is massively appreciated. And now I'll introduce our Executive Vice President of NCAIA and coordinator of this event, Ms. Shashi Agarwal. Shashi ji is a journalist and also producer of Manoranjan TV, and she's very well connected with community and public affairs. Shashi is going to facilitate this question and answer session. She has collected all the questions and she will present each question one by one to you. Shashi ji, over to you.
Thank you, Rajiv. Thank you, Manjit ji. आपने बहुत अच्छी तरह से ये जो है new tax laws explain किए. But still, I'm sure a lot of people, they have a lot of questions. So they send me a few questions, जो कि मैं one by one यहाँ पर बोलूँगी. So if you can explain. So one is, okay. Okay, Yogendra Gupta from Maryland, he's asking, if one is 70.5-year-old and retired, can he or she still open IRA account deductible? And his other question is, have you ever filed tax for anyone in India?
Gupta ji, namaskar. The answer to your question, I have never filed an income tax return for an individual in India. Clarification here. If you go as a US citizen and live in India, yes, we have done those tax returns, about 100 to 158 a year. But if you're asking me if I have done a tax return for an individual who has resources, needs to file, required to file an income tax return in India, the answer to that one is no. I do work with a couple of CAs, chartered accountants in Delhi, because they were my classmates in Delhi. You need reference, it will be a pleasure to introduce you on the internet with those individuals. Now, to your question on the IRA, or if you're 70.5 years of age, while we were doing the presentation, I indicated to you that you can put money into IRAs or any kind of a retirement fund, Roth or traditional, if it is definition earned income. Earned income के हिसाब से, whether it was subjected to the Social Security and Medicare taxes or not. And like I pointed out, the exception is when you are receiving postdoctorate scholarships or the assistantship from NIH and such similar organization. They are considered compensation, but not subject to Social Security and Medicare taxes. So please do send me an email if this doesn't answer your question. I'll be happy to give it more time, more thought on it, and give you more explanation on it.
Okay, the next question is tax consequences of inheriting IRA money. I have money in 457 plan, government sponsored IRA. After my death, my kids would inherit the money. What options they have to minimize the tax burden?
I hate to say this, no options to minimize taxes. Once they inherit, they are going on your IRA account, the 457 plan account, you have already dictated who the beneficiary are. That plan executor is going to transfer the funds to those individuals. In order to kind of control the withdrawal, let's say you nominate 3 people. All those 3 people will have to open an individual retirement account and receive the funds from the 457 as described by you. From that point onwards, they are eligible to take the monies out as and when they can control it. There is a restriction on the number of years that you can take to withdraw. 5 years? And there is a minimum required distribution out of it as well. Okay, sir?
Thank you. Next question is, it's from Amod Desai ji. How do I invest regular IRA, not 457 plan? So how do I invest regular IRA money in real estate or other business as an IRA?
That's a very good question, sir. Very, very good. Remember, if you withdraw the money out of an individual retirement account, you are subject to the income taxes. And if you are under the age of 57 and 59 and a half, you are subject to 10% early withdrawal penalty. There are specialized firms who create self-directed IRA accounts. You need to engage the services of those firms who will act on your behalf. So you can create a self-directed IRA, traditional IRA, or a Roth IRA, and invest in stock market. You lose, your IRA account becomes zero. You take the money and you buy real estate as an investment property, not primary residence, investment property, rental property, commercial property for rental purposes. Please bear in mind, the deed or the title is not going to be in your name. It's going to be in the name of the individual retirement account. You guys can set up one self-directed IRA account to have 3, 4 people come in and fund the IRA. And then use those funds and go and buy a $4 million, $5 million office rental building. The lease agreement for the office rental building, the tenants is going to pay the individual retirement account, not you, not the other investors who join hands with you. Please bear in mind, all the expenses must be paid out of that self-directed IRA. You are not allowed to take any distribution out of that. If you do, that distribution is subject to income taxes. And of course, penalty, if applicable, based on the age. We have dealt with 3 or 4 individuals, investors. There's a firm in San Francisco, there's a firm in Frederick, Maryland that have established what we call the self-directed IRA for our clients. Please don't hesitate, reach out to us, I'll give you the names.
Thank you, Manjit Singh ji. Next question is from Asha ji. How retired people can contribute in both, how they can contribute in Roth IRA and how the amount of this Roth will be guided.
Asha ji, I'm sorry. If you're working at some place and you have the 401k plan there, now you're retiring and you want to take that 401k plan and put it into Roth IRA. That transfer, because if the Roth, the traditional, if the 401k one was at 401 traditional where you got the tax benefits of not paying income taxes on that contributions, even though your employer matched it, you convert, roll over the money into the Roth, you are liable to pay the income tax. It may be a good idea if not, don't do it at the same year when you are retiring. Try and look at the year after or 2 years when you have the least amount of income, because then you're gonna be paying the least amount of income tax. Let's say you're in a 22% tax bracket today. After the retiring, after you leave job, 2022, because 2021 is the when you retired. Let's say in the beginning of the year, you may not have any additional W-2 income coming from the high sources. You may have just the pension coming. You may be with the deductions of standard deduction and other benefits. You may be in a, let's say, 10% tax bracket. This is the time frame when you're gonna move the money from your 401k account, which was tax favored account, into Roth account, and move only that amount that doesn't push you into the higher tax bracket. That's the strategy I would play with. If you want more information, I'll be happy to put you in touch with somebody who works on these kinds of things in our office. Next.
Thank you, Manjit Singh ji. The next question is from Binita Singh. She sold a business in January and there's $2 million capital gain on that. What's the best way to save on 31% tax on that capital gain?
आपके question, because क्या नाम बताया था जी?
Binita Singh.
Miss Singh.
Binita.
Vanita ji, this is the reason I went over that schedule on the capital gains. First of all, you need to figure out, I hope that somebody has guided you on how to compute this capital gains. You sold a business. The business had depreciable assets. The whole thing may not be total capital gains. But if it is, remember, up to $500,000, no, for $500,000 or above was the slide that we had presented that the income tax bracket is the lowest for the capital gains. After that is 20%. So $2 million, 20%. You will be added the 3.8%, the NIIT, net investment income tax, which was quote unquote funding the Obamacare. And that's why it looks like the tax rate is higher. Do you think I got your answer? Hit on the nail on the head. कभी-कभी मेरा मुंह ठीक चलता नहीं है, दिमाग से आगे भागता है.
Okay.
मंजीत भाई, उसको कहीं और इन्वेस्टमेंट करके टैक्स बचाया जा सकता है ना?
I would like to say the answer no.
No, I believe you can invest on the opportunity zone.
उसके बारे में मैंने आपसे साथ बात की नहीं है.
So that's what I'm saying. I believe it can be invested in opportunity zone, and then you don't have to pay tax now. You have to pay tax later, 7 years later.
7 years later, अगर बाइडेन और हैरिस प्रेसिडेंसी में आ गई तो कितना हो जाएगा टैक्स रेट कैपिटल गेन्स? ये रिस्क लेना है. I agree with you. I'm not going to argue.
No, there's a law passed in 2017 by Trump that Trump wanted these kind of people who have money to invest in the building the opportunity zone area, do the business in opportunity zone area.
That was Mr. Gorang Seth? Was that Mr. Seth talking?
Yes, Sunil Singh.
All right. So the point, sir, that I just tried to make was whatever Trump did and investing in the zones, opportunity zones, is a great idea. But हमारा जो बुड्ढा दफ्तर में आया है नया, उसको पैसा चाहिए. कैपिटल गेन्स रेट ऑलरेडी बोल रहा है मैं बढ़ाएगा. तो उसके बाद जब आपको रिफंड्स वापस आएंगे, आपका इन्वेस्टमेंट वापस आएगा, what kind of level tax rate will be there? Because if this guy doesn't change it, that uncertainty, that risk is there. Like I said it in my presentation, I'm 63-year-old man. I love to have my money in my hands before I die. मेरे पीछे जो होता है होने दो.
Whoever is not talking, can you mute your phone, please?
पवन जी अपना माइक जो है म्यूट कीजिए.
Hey, I see Pawan Kumar, CPA. How there, man? Good. हाँ जी, शशि जी दूसरा क्वेश्चन चले.
हाँ जी मंजीत सिंह जी,
और भी बहुत सारे सवाल हैं.
गरंग साहब आप चिंता मत करें, आप ईमेल भेज दें, हम आपको और भी अच्छे क्वेश्चन, अच्छा आंसर ढूंढने के देंगे.
Okay, next question मंजीत जी from चेतन जी. वो कहते हैं, can we do 50% in Roth and 50% in traditional?
Yes, you can. Traditional IRA, Roth IRA, individually, yes. If you have an employer that offers you 401k plan, they also have the same options. You can contribute into what percentage of the income you want to contribute into 401k, traditional, which is tax beneficial, deferred, or the Roth, which is not deferred. You have the option. Choice is yours. It's your money. You can investment. You dictate the terms to the 401k managers.
Thank you, Manjit ji. अगला question बिपिन सिंह जी का है. The people who are on H1 and L1 who have not received their stimulus check, are they allowed to claim while filing taxes?
H1B visa people are filing taxes. They are eligible. L1 visa is executive transfer from India, from one company to another company. You are eligible. Even though your visa says non-immigrant visa, you are paying Social Security and Medicare taxes. You are fully and wholly entitled to get the stimulus funds. That's my understanding. F1 student visas, no.
So stimulus check के लिए claim कर सकते हैं.
Yeah.
Okay.
Yeah, a lot of
there's a website on the IRS website. You can go and check. आपका पैसा आपको नहीं आया कि कहीं और चला गया किसी और के पास.
Thank you. Okay.
अगर इन्होंने tax return file किया as an H1B individual, if it is the first year going to be for the year 2020 or 2019, and they did not get into the groove of the things, they may have missed it. So when he does his individual tax return this year, there is a special field. Identify, I didn't get it. First one, second one. I got the first one, didn't get the second one. It will compute it. But also remember, there's income phase out levels. If you're making too much money, you may not get it. I'm emphasizing that point.
Secretary, I'm sorry to interrupt, but I saw there is another similar question on the same topic by Swagat Roy, and he wanted to know, in case if he's not a citizen or nor a GC holder and he got the stimulus check, is he supposed to return it back to IRS?
Yeah, I was going to ask that next. Sure.
Yo, you are not a green card holder, but what visa are you on?
H1.
You're entitled to.
So he's not supposed to return it back to IRS.
Nope.
Thank you. Thanks for clarifying.
Nope. If the IRS made a mistake and gave money to somebody who was not entitled to, they're not going to come back and claw it back from you. I have a guy who, the child is how much? 4 years old, or 6 years old, and they gave him the money. The person is dead and they gave him the money. In that person's situation, when he's dead, yes, we're supposed to return the check.
Well, thank you, Manjit ji. Next question from Asha Chanji. Is there any exemption in withdrawing our RMD from our TSP, 401k, and Roth, etc.?
Is there any exemption?
Mm-hmm.
Not to my knowledge.
Okay.
I have to check on that.
Okay.
Okay. Next question.
I don't want to give a wrong answer.
Okay. Next question from Aisha ji. What are the tax consequences on our small capital gains and long-term stock gains? Can you elaborate a little bit on that?
All right. Definition of a long term. If you have anything that you have held for more than 365 days, is considered categorized as a long-term gain. Anything less than that is short-term gain. So if you buy a stock in the morning and you sell it in the evening and you have a gain, it's short-term. Short-term gain is taxed at the tax bracket that you are in. If your all total income, adjusted gross income, and taxable income comes to you and puts you in a 10% tax bracket, capital gain tax will be 0. If it puts you in 22% tax bracket, capital gains tax will be 15%. I don't know how to show 15% on my fingers. Sorry.
Thank you.
Okay, next question is from Rajesh ji. Should we write our property value in India in our tax return for 2020?
Ashashi ji, I didn't mention this. This is a very, very good question. Remember, the F-bar reports that I talked about are the F-bar account report. Talks about cash equivalent. Does not say anything about your declaring that I have real estate, I have land, or anything. The answer to that question is no. If it is generating revenue, that revenue part needs to be reported.
Okay, thank you. Next question is from Madhav Rao ji. Can we deduct the health insurance premium from the income tax?
Depends on what kind of health insurance premium you are proposing. These days, employers pay for your health insurance. It is pre-tax dollars. The code is on your W-2, double D. So the amount that shows up on your W-2 box 1 has already accounted for to be non-taxable funds. So therefore, you are not eligible to write off on your tax return. Second, if you have taken Obamacare and you are paying partial payments, the answer is no. Third part, if you have medical expenses, health insurance premium for your dependents who are on your tax return, which means they have the social security number to be claimed on the, or the IT number to be claimed on the income tax return. They all go part of itemized deduction top section. And that area is limited by 7.5% of your adjusted gross income. So if your adjusted gross income is $100,000, 7.5% of 100,000 is 7,500. If your medical expenses, health insurance premium paid out of your pocket, not the pre-tax, just look what on the one that you got the benefit of, will add up to that form on the right side. Then you're going to add up the rest of the form. If it's below standard deduction, the total is below standard deduction, I'm sorry, you didn't get the benefit. When I came in this country in 79 or 1980, if I remember correctly, President Reagan came into the office in 1982, 83. He made that limit to be 2% of the AGI. Slowly and steadily, 2%, 5%, 7.5%. Think about it, ladies and gentlemen. You see the movies where you see the people at the beach playing the toys. टोपी यहाँ पे किया, वहाँ पे किया, यहाँ किया, बीच में एक वो रखा होता है कंचा. Basically, the government needs the money that just increase the threshold for you to be able to claim the deduction. And if you are not meeting the threshold, you're not getting the deduction, the government is sitting on your money in terms of a higher income tax. So for people who have the ability to get health insurance, should get health insurance from their employer rather than trying to pay it out of their own pocket. Let me know if I have I can elaborate on that more.
Okay,
outside
thank
the
you.
forum.
Okay, next question is from Pawan Kumarji, CPA. Is free software provided by RSA for filing tax return? If yes, is there any income limit?
Pawan Kumarji, yes, there is always a limit. Because I want you to understand one thing. IRS does not write tax softwares. They just creates softwares that is going to be implementing the tax laws. It's companies like HR Block, TurboTax, Tax Act, and hundreds of other companies like such that create the software. So they go and do a joint venture, or shall I say, a partnership with the Internal Revenue Service. And therefore, the Internal Revenue Service pays these firms to allow low-income people to be able to use the software to do the tax returns and submit the returns electronically to the Internal Revenue Service. As I'm not sure if you have heard or not, when the IRS closed down because of the lockdown and they opened up, there were 12 million pieces of mail that they had to sort out. Imagine how many of them were individual tax return filed manually. Even today, February 21, IRS is not caught up processing all the income tax returns that came in the mail for 2019 as yet. So IRS wants individuals to work with some firms to file the returns electronically. And if their income level is low, the firms that are allowing you to utilize their platforms are somehow getting compensated from the Internal Revenue Service. And think about the other way. Once you're using their software and your income level goes up, instead of going back to a second person next year, or a third person next year, you're gonna continue because, hey, my data is already in this software. Let me pay them $100 today or $125. Move on, instead of going and trying to shop around with somebody else. They also have their vested interest. Does that make sense, Mr. Kumar?
Okay, next
Kumar
question
साहब
is,
मेरे को email भेज सकते हैं. He is my Facebook friend.
okay, that's good. Thank you, Manjit Singh ji. The next question is from Grish Jain ji. वो पूछते हैं, we have purchased our first home last year, not delivered yet. What kind of tax benefits can you avail, if any?
Girish ji, you are in a very kind of good position, I would say. All right.
Okay.
Right now, interest rates are extremely low. When you say you have purchased it, that means you have put in an agreement, a contract, but you have not been delivered the property. So that means you have not gone to the settlement yet. When you settle, that's when you exchange the deeds that you are the legal owner. So if the things that are deductible when you buy a new home, in the past used to be the real estate taxes, the interest that you pay for the days between the closing and the next month payment that you will be due. There's one thing else, points. What is points? Points is the interest that you are paying at the time of the closing to lower your interest rate for the next 15 years or the 30 years on that specific
The origination
mortgage.
point, right? Right.
So if you are paying points, you have the resources, the cash flow, and you want to pay more points to reduce the interest. Remember, theoretically, the interest is already artificially depressed. And then you have to look at what your itemized deduction will project like. Is that going to be equal to the standard deduction or lower than the standard deduction? Does that make a difference or not? So it is a delicate balancing act that you have to do to be able to claim the points.
Got it. Thank you, sir.
In the past, I used to pay points when I used to refinance my property, even though it was not deductible. Refinance, non-deductible. I amortized over the life of the loan. First time purchase, deductible. Shashi ji?
Thank you, Manjit ji. And Grish Jain ji, अपना जो है आप Zoom mute कर लीजिए. अच्छा, next question है from Mr. B. It says, what is the best way of buying properties, investments on kids' name or on US, thou have a business for best tax benefits in India, USA or other countries?
Sir, I am not an India tax expert. So I would like to twist my card to stay away from that area. What's the best way to buy proper investment property in the US? Just remember, one of the things that you have, if you have an investment property, a rental property, and somebody does something stupid in there, and that person's relative comes and sues you and says, hey, you wanted the property to be vacated, you put a mental pressure on my XYZ, and he committed suicide. Are you liable? That is the kind of things that I as a tax specialist or person with knowledge like to advise you to buy real estate, investment properties, commercial properties in a LLC. What it does is it creates a circle. And I was explaining to somebody the other day, it's like a Lakshman Rekha. This is you, this is your investment. No interaction. And it says your assets, personal assets, as what we call asset protection, all right? Now comes the question about children. The children can be a member of the LLC as long as they are legal age to sign contracts, which means 18 years of age. But on the other hand, if you have the LLC in your own name and you want it to go to your X number child, not the 1, 2, 3, just the second one, what you would do is put it in your will that the membership certificate of this LLC goes to my number 2 child after my death. So now you see, he got the property, whatever the fair market value is at that time. In order to get additional information on this, I would highly recommend you discuss it with a real estate attorney. Remember, I'm emphasizing the word attorney because this is passing the property over to somebody else after you passing, and who's going to pick up as income in terms of rental income and all of the benefits. If you don't agree with me, you're always welcome to send me your thoughts. I'm always open-minded. Shashi ji, chale.
Thank you, Manjit ji. Next question is from Vijay Kumar ji. He's saying, I am H-1B visa and I have DMAT account in India. Is it mandatory to file taxes on income I earned for my equity trading from my Indian DMAT account?
Yes, my dear friend, Mr. H-1B visa. Remember what I told you. Cash, cash equivalent, DMAT accounts, stock accounts. The gain or loss on those accounts are reported on the US income tax return on Schedule D. You will identify, this is the amount of money I made on it. There is a form that is done, and it's, if I'm not mistaken, it's called PFIC. Not an easy form to do. I have, in the last 15 years, I have recommended my clients get out of the DMAT accounts. They are not worth the pain, the money that they provide you in terms of the reporting issue. Unless you can transfer the account to somebody else who is not subject to income taxes in the US. Take one-time hit, report it, move on. Challenge Sashi ji.
Okay, Manjit ji. अगला question है again पवन जी पूछते हैं. Please explain reverse exchange IRC 1031 and how much does it cost?
Reverse exchange?
Ji.
I'm sorry, my dear friend. I haven't done a reverse 1031 exchange. I would like to know a little more what you mean by it. For those people who are listening, a 1031 exchange is I have one property in my investment portfolio. And if I sell today, I will make profit on it, not only because the market value has gone higher than what I had bought it for, but also I have to pick up the amount of depreciation that I had been claiming for the period it was rented or generating rental income or anything, okay? So there is income generated, profit may be higher than what money I take in my pocket and walk away with. In order to avoid the tax on this gain, 1031 exchange needs to be done through a qualified intermediary. Manjit Singh is not. There are other firms who specialize. What they do is, quote unquote, create a trust, temporary trust. The sale transaction comes in there, the money comes in here, And then the money is used to buy a replacement property, one property or two property, or three property, as one of our clients did 5 years ago, for each child. Now, the cost of those properties, even though they may be paying whatever they may be paying for the market value, for the tax purposes, the depreciation amounts that was claimed on the one property will be used to reduce the fair market value on those three properties, so that when those three properties are sold anytime, at the same time, different time, whatever, the cost is reduced by the profit on which the tax was not paid in the previous year. So artificially, what we are saying in a 1031 exchange, we are not going to pay the tax today, we're pushing it towards the future. The word reverse, I guess Mr. Kumar wants to say that, how will it work that I have three properties and I want to put it into one property? The mechanics would be the same. You will go through a qualified intermediary and conclude the transaction that way.
Okay, Manjit ji,
Mr.
next.
Kumar, feel free to tell me if I'm wrong.
No, thank you so much.
Exactly
Thank
what
you
you
for
meant.
explaining.
Okay, the next question is from Sam. How about putting properties in trust instead of LLC?
Basically, it's the same thing. Basically, it's the same thing.
Okay.
When you create an LLC, you're creating a circle.
Okay.
You and the LLC is two different people. When you create a trust, you're putting not one property, but two or three properties into trust. Now, the trust is also, there are different kinds, revocable and irrevocable. So you put a property in the trust.
Okay.
The trust becomes alive if you die, when you die. Okay? Or alternatively, if you're going to create a trust by itself and let the property be held by the trust rates are higher than the individual income tax rates. So you need to be very careful why you want to put it in trust. Estate, E-S-T-A-T-E, not real estate, estate. जिसे हम हिंदी में बोलते हैं जायदाद. अमेरिका में today's date, the estate tax exemptions is up to 11.3 million for husband, 11.3 million for the wife. If you have the amounts, you liquidate the estate and the cash flow or the gain, wrong. Let me recorrect, cash flow is wrong. The gain on the liquidation of the estate is greater than 22.6 million if both the people died at the same time. The estate tax on amount over 22.6 million will be subject to estate tax, not income, estate, as high as 45%. So think about it. How do you want to manage it? And better talk to an estate attorney, not a CPA. CPA can just talk to you about taxes, all right? Hanji Sashi ji.
Thank you, Manjit Singh ji. ये last question है गिरीश जैन जी का. How do you open LLC and how much does it cost?
Everybody wants to make money. Depends where you want to set up the LLC. The ideal place where you want to set up the LLC is where your real estate investment property is going to be, or where you're going to conduct business. Because remember, as LLC can be created for ownership in the real estate, LLC can also be created to operate a IT business, what we call a store, pizza franchise, whatever, okay? the purpose of creating an LLC is to isolate you from the liabilities of that activity, real estate or business activity. Who gives you that limited liability? Is the state where you're doing the business, not the federal government. So from that perspective, if you live in Maryland and you are going to buy an investment property in Virginia Beach, you should have a LLC in Virginia Beach. The cost associated is in Virginia, $100 to set up the LLC at the state corporate commission level. Registered agent that you may need, who's a member of the LLC, or you may hire an attorney to do it, and that's a one-time fee every year. Accountants do it, and the cost can be anywhere close to around $500 to $600. There are a lot of services available online, Zoom, Inc., that can set it up. They'll act as your, what you call, a registered agent, and give you the paperwork, get you the federal ID number for the LLC from the Internal Revenue Service.
Shashiji, there is one last question that I just received from Mr. Pramod Kiranraj. Can I, or should I ask him to send over email?
No, you can ask.
Okay, thanks. So Pramod is an US citizen and he's planning to move to India in 2021. And he wants to know if he rents his primary residence in the USA while he lives in India, what address should be used for filing taxes? Indian address or the US address?
My dear Pramod, I would recommend that you use an address where you are sure you're gonna get your correspondence from the Internal Revenue Service. I have an individual that has been my client since 1997. He's a US citizen. He lives in India, 6 months here, and he manipulates the one day that he usually needs. He uses our office address as his address so that we get all his correspondence here. Can I request you to repeat that question? What? Okay. If he's going to rent his property, he will be liable to pay income taxes in the US on the rental income. Because he's a US citizen and living in India, and if he's earning income in India, he'll be filing an income tax return in India, getting it done from a qualified chartered accountant, provided to the CPAs in the US to integrate with the US income tax return, including the income taxes paid in India, so that we claim the credit for taxes paid to income in India. The word go back, the tax treaty between India and US was signed way back in 1982. There shall be no double taxation. So we get the credit. For him, I would like to emphasize one thing. I'm not sure how many years you're gonna go and live in India, how often you're gonna come and go back. If you are ready and willing to continue with the headache of managing our rental real estate, more power to you, sir. But remember, if you sell the property today, you have married filing joint who have lived in the house 2 out of the past 5 years, has $500,000 exclusion, section 121 exclusion from income tax. So if you make profit, when you bought the property, all costs included, closing costs and everything. You sell the property, all selling expenses included flat, minus. Your gain is $475,000. You and your wife jointly owned it, lived in it, at least 2 years before the date of the sale. You don't have to pay income tax on that profit of $475,000. Now, If you are thinking that you will get better value in the future because you're not getting better value today, the same rule applies 2 out of the past 5 years. So if you convert the property to rental property today, you have 5 years window to look at. Or should I correct myself to 3-year window? Because I want you to include the 2 years most recent that you lived there. And I'm saying 5 years, so 3 years. If you sell the property before the end of that 3 years, since it was converted to rental property, you still have the benefit of the Section 121 if the new administration does not change the law. The period that it was rented, you claim depreciation. You may have to recapture and pay tax on that depreciation that you did not, or it helped you save taxes. If it did not help you save taxes, it goes into something called suspended. Those suspended losses will be released at the time of sale. So depreciation not gotten, suspended losses offsetting each other, and maybe you'll pay a little gain, and you'll pay tax on that little gain, and you still may be able to exclude Section 121 amount as non-taxable. I'd love to give you more information on this. Please don't hesitate. Shoot me an email or send me a message on Facebook.
Thank you, Manjit ji. Definitely. I'll send you an email and reach out to you.
Okay, I got one more question. It's from Beena ji. वो कहती है, we registered our business and organization in particular state and working international. With our expansion, can we do that? We are not sure. We can ask here or over the phone.
I would request you to ask over phone because you're working overseas is the part I didn't understand, and extension I didn't understand. शशि जी एक बार क्वेश्चन दोबारा पढ़े.
अच्छा, क्वेश्चन भी वैसे क्लियर नहीं है. वो कहती हैं, we registered our business and organization in particular state and working international with our expansion. We can do that. We are not sure. We can ask here or over the phone.
I think I'd rather take that question privately.
Okay.
क्योंकि वो extension लफ्ज़ समझ नहीं आ रहा.
Yeah, मुझको भी समझ नहीं आया क्वेश्चन. तो वैसे राजीव जी ने आपका कॉन्टैक्ट नंबर एंड एड्रेस दिया है. इन केस एनीवन वांट्स टू कॉन्टैक्ट यू, दे कैन कॉन्टैक्ट डायरेक्ट.
राजीव जी फोन लाइन ओपन कर दो, अगर किसी को कोई क्वेश्चन पूछना है डायरेक्टली दे कैन आस्क.
Okay, hello everyone. I have unmuted everyone, and this probably will be your last chance to ask any questions for this session. So feel free to unmute yourself and ask the question before we...
I have a question I wanted to ask. This is Mithun. Namaste, Manjit ji.
Namaste ji.
Thank you very much. So I wanted to ask about the FATCA. You just said about FATCA reporting. So that actually didn't elaborate much, because I wanted to know, because there are a lot of people may have money in India and may getting the interest income over there, and then they have to report into IRS, not in Indian government, because they get a tax exempt status over there because you're reporting as US citizen or green card holder in India, US. So how you need to do that? Do you need to do the FBAR, or you have to do FATCA, or you have to report that to FCNR, those things?
Okay. We did not talk about FATCA. I casually mentioned the word FATCA. 7 years ago, 8 years ago, everybody was being pushed to report their foreign interest income from the banks, rental income from the banks. But remember, people were still using their personal address or their parents' address when they had opened up the bank accounts in India. They never gave the banks their US address. So the banks in India were not aware that this gentleman lives in the US. When do you have, for that purpose, you have to have a special kind of an account in India. When the bank pays you interest, they automatically do a 30% TDS, tax deducted at source, and remit to the Indian government. It's reported on Form 1616A. Either it is reported every quarter. And remember, Indian tax year is April 1 to March 31st. So people do provide us with the 1616A forms that we know they got the interest. And sometimes the interest reported is minus the 30%. So from that perspective, we do need to know, get the form 1616A and get the right amount. Some of the current banks, ICICI, they are telling us, giving us the reports on an annual basis, calendar year basis, the American system. And it tells us at the end of this quarter, we get them this much interest. This is the TDS taken out of their bank account. The FATCA rule was by the US government on the banks, not the individuals, on the banks. You want to do business with the United States? You provide us with the information on your depositors who live in the United States so that they can match up who's reporting the rent incomes that they're getting in India.
No, but what if they have the US address? Banks has US address, and if it is the NRO, NRE account, you don't have to pay taxes over there. So you have to pay tax here. How do you need to declare? I think you have to report that to the financial crime department or something, FATCA account.
No, that's not FATCA, that's FinCEN, all right?
FinCEN,
you report that total interest on your Schedule B, India Bank, or XYZ Bank, ABC Bank. I got this much interest, all right? And then if you're using the software yourself to do it using TurboTax or tax cut everything, there's an option there. Is the foreign tax withheld less than $500? You check that box. You don't have to prepare a Form 1116, credit for taxes paid overseas. As long as it's less than that dollar amount threshold. Some says it's 600, some says 500, okay? When the tax form is computed, the 1040, you will see credit for foreign tax there. In the past, when that limit was not there on $10,000 on the standard deduction, people doing their income tax return the simple way used to just claim it there instead of getting involved in creating the form 1116.
You're right, Manjit ji.
Thank you.
What is happening. The interest
Thank you, Manjit bhai. आपने बहुत हर क्वेश्चन का बहुत अच्छा जवाब दिया. Back to Rajiv ji. Rajiv.
Thank you, Shashi ji.
Rajiv ji, can you unmute me?
You are already unmuted.
Okay, thank you.
Yogenji, if you permit, can we ask Mukundji to say the vote of thanks and we should close the session because we are almost to the close of 2 hours and probably it might not be comfortable for everyone.
Yes, go ahead, Rajiv ji. Mukund ji ko bulaiye.
Thank you. So Manjit ji, thank you very much. And I would like to invite our one of members of NCAIA, Mukundji, who is Vice President of the organization and has been involved with NCAIA ever since its inception, along with our chairman, Sunil Singh. He has been living in Maryland for over 30 years and has background in IT. In the past, he has been president of ICCC and FIA, National Capital Region, and is an active member of Marathi Kala Mandal of Washington, D.C. Mukundji, please.
Thank you, Kamalji. First of all, thanks a lot, Manjitji, for a great presentation. Please give a big round of applause to our expert today, Manjit Singh.
Thank you very much. Thank you. Very obliged. I was honored to do the presentation. Thank you.
Thank you. I mean, we all
Very
know
well done, Manjit ji. It's
our
very well done, very educational. Lot of points you highlighted which were not understood earlier, but
गुप्ता जी,
please, that's very
अरे
good.
मुकुंद भाई वोट आप थैंक कर रहे हैं उनको करने दीजिए.
Thank you, Sunil bhai. No,
Mukund bhai was complete his thanks.
no, I did not. I was just started my first sentence. We all know our
I'm sorry.
tax laws are extremely complex and many times very difficult to understand. But today, Manjit made this complex subject as easy as possible to understand this thing. To many people, taxes are boring subjects, but it is very important for everyone to understand it affects our money, it affects our bottom line, it puts money directly into your pocket. So please take enough interest in this one. Most of the times we need a professional help to navigate through this complex tax structure, like person like Manjit Singh. But even to have an intelligent conversation with an expert, you need to understand the basic taxes, I think. And he minimizing the taxes is something you do not only in March and April, but throughout the year you need to plan this thing. I really want to thank Manjit ji once again for touching so many subjects of the tax. I mean, whether it was IRA, Roth IRA, 1031, even exchange, and many of these things. So please reach out to him if you have a question on your personal taxes. This is the perfect time to reach out to him. I'm sure he's going to be extremely busy in this tax season until 15 April, but he will find time to help Indian community. Thank you once again, Manjit ji.
Thank
Thanks a
you
lot,
very much.
Mukundji. Thanks a lot for kind words. And let me express my sincere gratitude to all the participants who joined in today to make it a huge success. I'm also thankful to the senior leaders and mentors of NCIA, to name a few: Mr. Sunil Singh, Chairman, Mr. Kripa Singh, Naina ji, Shashi ji, Asha ji, and everyone, all the senior leaders like Dr. Harswarup Singh, Dr. Bani. My sincere thanks to everyone for their unerring efforts to make this event happen today. And having said that, we'll wrap up this event. Last and not least, thank you to Mr. Manjit Singh, and we'll meet again with our next event. Thank you.